welcome the first presenter today, Monterro. It's Managing Director Erik Syren and Manager Daniel Bertlin. And Daniel and Erik, we are looking very much forward to your presentation and hearing your insights from your Nordic Software Benchmark report. So please go ahead from here. Thank you.
Thank you, Casper. So my name is Erik Syren. I'm head of the operations team at Monterro. Previously, I've been running a software company named Lime Technologies for more than 25 years and took that company from 5 employees up to more than 500. Done more or less everything in a software company. I have done sales myself. I have done implementations. I have answering the telephone and helping the customer in the customer support and working with the product management as well. And Daniel.
Yeah, my name is Daniel Bertlin. I'm an operations manager at Monterro. I think next week is my 2-year anniversary at Monterro. Before that, I spent some years working as a consultant, supporting software companies and tech companies. Glad to be here today.
And very important to say that you're Danish as well. So yes. Half or 100%, or what are you saying?
Half Danish, quarter Swedish, quarter Finnish, but I was born in Denmark.
So a great mixture in the Nordics. So
exactly.
Perfect. The agenda in our presentation today is that we start off to make a small and short introduction to Monterro. And after that, Daniel will present our software benchmark. So every year we do a survey among all the B2B software companies in the Nordics. I think we have had more than 300 people answer this survey this year. And there are a lot of insights, a lot of findings in this report, and we will share those today. So first, a short intro of Monterro. So as I said earlier, previously I have been running a software company myself. And that's something the majority of the employees at Monterro has done themselves. So we have a unique operational background. And that's very different compared to other investors out on the market. So the three things we stand out compared to other investors is that we just focus on B2B software companies. That's the only thing we do and the only thing we can do. So we try to be really focused on that one. Second, the majority, as I said, we have an operational background. We have done this ourselves. If you compare us compared to other investors, they often come from the banking or the finance industry. We come from the operational background. And third, 25% of the capital we invest is our own money. Why is that important then? Because we care about our own money, we have the skin in the game, and that means that we are really hands-on and helping great entrepreneurs running their company. We have one of our companies presenting this afternoon, AD Analytics, and we do this in a tight cooperation together with Nicholas, the CEO in that company, and the rest of the management team. Today we have 20 portfolio company across the Nordics. So we are helping those companies going abroad. So we take great companies, local companies in Nordics, and expand them to the rest of Europe, but the rest of and also the rest of the world, of course. We have done 28 platforms investments since 2013, when we were established. And we have done 8 successful exits so far. And now we have approximately 13 billion SEK under assets under management. And we have a lot of capital to invest in even more companies across the Nordics. When we talk about our customers, we talk about software companies, we talk about our portfolio companies. So that's really important for us. And when we talk about our product, we talk about what we can offer our portfolio companies and our potential portfolio companies out there. So we try to work with our product, our offering, and this is you can see the model on this slide, how we describe our package or our solution. We have 44 components in this product, what we can offer. And just to give you a few examples, what we do and help our customers with is that first, many of our software portfolio companies, they have a bottleneck for them is to increase the productivity and also the development of the products. So they often need more developers to increase the pace. To help them to recruit even more developers, we have an office down in Hanoi where we actually help our companies, our portfolio companies, to set up a daughter company down in Hanoi. So this is not offshoring, this is not outsourcing. This is their own development department down in Hanoi. So what we facilitate is that we have an office. We have 5 employees down there, helping them with all the governance, the contact with the government, and also all the recruitment process. Today, we have approximately 150 employees working for our portfolio companies, and we increase the amount a lot every year. We also help our portfolio companies with recruitments, recruiting even more people. So we have 2 recruiters at Monterro helping our portfolio companies to do that. And also, as I mentioned earlier, we try to help them to expand to new markets, and we're also helping them with different go-to-market strategies, pricing projects, etc., etc. So we have, as I said, 44 components in our product, and all of the components is to accelerate growth for our portfolio companies. Daniel.
Yes, so I'll start by just giving a brief introduction to our benchmark report before jumping into the findings. But as Eric mentioned, there's this year's survey has about 300 respondents across the Nordics, and it's the largest one to date. All the respondents are sort of C-level founders, co-founders, CEOs, and other C-level positions. And this is just sort of a very brief summary of a large report that you can find on our website. There's I've included a QR code at the end of the presentation as well, so you can get to it. So see this as an introduction, a brief summary, and then we hope that you download the full report online and that you participate in the survey next year. So the key findings. First of all, we see that growth rates remained strong in 2023, but sentiment going into to this year has been a bit more cautious. One of the main reasons for this caution is that a lot of companies feel that sales is becoming more of a challenge. It's a trend that we've seen since we started with this survey, but it's even more prevalent in this year's data. As such, a lot of the companies have focused inwards. This is also a trend that we've seen as sales is becoming harder, that they focused inwards and see what can we do with our existing customer base with regards to upsell and cross-sell and so forth. But this is also now becoming more and more difficult. AI was a topic that when we launched the report last year, I think it was like a month later, and then everybody was talking about AI, and we didn't really have that in the survey. So had to shoehorn in some findings at the end. But this year we included some questions around AI in the survey from the beginning, and we think we have some good insights both from the survey and from our own portfolio. And then finally, vertical software companies are outperforming the horizontal companies in most of the KPIs that we have benchmarked. This, of course, doesn't mean that you should shut down if you're a horizontal software business, but there are some things that a horizontal business can learn from the vertical ones to improve their performance. So jumping in, growth rates, as I said, they remain strong. This is, of course, sort of self-estimated, so there's always some usually some optimism with founders, especially looking ahead. But this are still very good numbers, numbers that in a international context are very good. This somewhat surprised us that the trend of sort of believing in high growth continues. We feel that when we've been out speaking with companies and when we look in our own portfolio, there is a bit more caution going ahead. So in this year's report, we added a new benchmark or new measurement, you can say. So net growth sentiment. If you're familiar with net promoter score, this is somewhat similar. So we take the share that believe in accelerating growth, deducting the share that believe in decelerating growth, and this gives us this net growth sentiment measurement. And here we see this pessimism or lack of optimism a bit more clearly. So after a couple of years of sort of turmoil in the market, but still good performance, it seems that the market is now finally catching up, and a lot of companies are having a harder and harder time keeping up growth. And so 24% now believe in de-accelerating growth in this year, the highest that we've seen since we started with this survey. As I mentioned, a lot of this is due to sales becoming more and more difficult. Sales is always a huge topic for tech companies, but going from 44% seeing it as their key challenge, we're now up at 72%. And we also see this in other benchmarks. So CAC payback, sort of the time it takes to earn back the money you spend at getting a new customer, we see this KPI has gone up over the last few years as well. So it's not just a feeling; we actually see it in the data as well. And this is across different sales motions or go-to-market models. This topic of different go-to-market models is new for newly included in this year's survey. So last few years we've heard a lot of comments that all these benchmarks are great, but we have a different go-to-market model, so it doesn't apply to us, or we need some other benchmarks that fit the way we work. So we included this differentiation according to go-to-market model, looking at the different sort of the main types. And we see enterprise sales is the most common overall, and especially when you look at the larger deal sizes, this is where enterprise sales, the longer sales cycle, more stakeholders, more complex sales processes are the most common. While when you look at the smaller deal sizes, there's more sort of inbound, marketing-led, product-led growth, those types of sales motions. This is also somewhat required if you want to get profitability out of the sales. If you have the very small deal sizes, spending years and years negotiating these in an enterprise-led sales becomes very expensive and hard to get profitable. Diving further into these different go-to-market models and how the different benchmarks differ, we blurred out some to sort of focus the attention, but you can see all the KPIs you can see in the full report. But if we start from the top, we see that marketing or a partner-led sales motion I think what stands out here is that you still have quite a bit of people in the sales organization. We hear a lot of companies saying that we haven't really invested in that side of the organization because we have partners and they are our sort of outsourced or external sales force. But you still need people internally to make this work. Whether you call them salespeople or you call them partner managers, it doesn't really matter. But it's still people that fill the role of guiding customers through the pipeline. Jumping then to marketing led, here obviously we see a larger spend on external marketing, and we see a larger share of FTEs in the marketing department. But it's especially on the external marketing spend, it's not a huge amount. So even though you have a sort of communicated sales motion of doing marketing led, you shouldn't get too excited and spend too much money on this because the profitability can quickly go down. Then inside sales, so shorter sales cycles, usually fewer stakeholders, but still an outbound motion. Here we see the shortest CAC payback time. So companies they make back the investment in getting new customers in under a year, which is very good. Even especially considering that they have the smallest deal size per salesperson. However, they have a larger sales force. This is usually because they have a sort of a more junior sales force, but perhaps a bit hungrier, a bit more cold calling, a bit more of that type of sales activities. But here it is important to manage the sales force correctly, making sure that they go for the right customers and don't sell too far outside of the ICP, because what we can see is this is also the sales motion that has the highest level of churn. So a more junior, more excited sales force tends to end up selling a bit outside of the ICP, and that results in higher churn. And then finally, the enterprise-led. It is longer sales cycles, more expensive to conduct those, and as such, you have a longer CAC payback of 14 months. You have a smaller sales force, more senior salespersons usually, but you also have the lowest churn and the highest net revenue retention. So even though it takes a bit longer and it is a bit more expensive to get the customers in, you usually retain them for longer, and you have a better ability to upsell and cross-sell to those customers once they're in the door. On the topic of cross-selling and upselling and this sort of expanding on the existing customer base, this is a topic that we've seen increasing over the last few years, as I mentioned before. So it's now up at close to 60%. Let's see this as one of the main focus areas for 2024. The main sort of KPI that we usually track in relation to this upsell and cross-sell and expanding on the existing customer base is this net revenue retention. So the share of revenue that you can gain from your existing customer base. And we see this getting harder and harder. It's been a focus for a lot of companies for the last few years. And at some point you sort of have depleted the available demand in your customer base, and this measurement starts going down. We see now that it's gone down almost 4 percentage points from last year's survey to this one. And if you adjust for pricing, so the share of this upsell that comes from increasing prices, we're actually sort of below 100%, which means that on a volume basis, companies are losing licenses or seats or however they sell the software.
And that's pretty interesting because also the churn numbers is going down. So they're losing customers in a lower, not so many customers as they did the previous years. However, what we see is, despite that they focus on expansion to existing customers, we see that with the price increases, they downgrade the number of licenses existing customers. So despite the efforts to expand and focus on expansion, they haven't succeeded with that in 2023.
Exactly. Moving on to AI, here we've seen sort of two different dynamics. So we see that the larger companies, they have a bit more resources, a bit more both sort of time and money-wise to spend on implementing AI. However, a lot of this AI investments has been going into sort of making the operational side, the cost side of the business more efficient. So using AI in support, using it in R&D, using it in those types of internal processes. While on the other end of the spectrum, we have the smaller companies, more of the startups that are born out of AI, so the core product is AI driven. These are more, they're selling AI as a service to their customers, and have implemented it that way. And then we have the companies in the middle, the ones that are sort of it's a bit more heads down focus on building on what you already have, and as such you have a harder time dedicating resources to AI. And we see that in our own portfolio as well, that you really, if you want to do something here, you need to actually dedicate some resources, dedicate some time, and get a proper strategy around this. Otherwise, it's hard to make a proper dent and make a difference. It becomes a lot of sort of disparate projects around the organization that it's where it's easy to lose track of it and not get sort of the value that you expect out of it.
We think this is a good step. A first step is to start using AI internally for internal processes. It could be sales, it could be development, it could be marketing, to explore and then try to figure out how we can improve our product offering with AI, both organic but also inorganic. In the second step, and then doing that as a feature and as a core in the product. So we see the same trend among our portfolio companies as the report showing here.
And then finally, the topic of vertical versus horizontal software companies. So here we see that the vertical software companies are outperforming on growth rate, higher deal size, shorter payback time, lower churn, and a better ability to increase prices. Slightly lower NPS, which was a bit surprising. Usually it is the other way around.
We basically see that as an arrow in the report, Daniel.
Exactly. Usually a sort of classic horizontal software, sort of ERP, CRM systems are sort of notorious for having very low NPS scores. But overall, I think it's fairly clear that the vertical software companies are outperforming. So what then to do if you are a horizontal? Well, we've been working a lot with our portfolio companies on verticalization. So making sure that you focus in on some verticals that you feel that you have a better traction with, focusing the sales, the marketing, and the product development on features that address these target verticals instead of trying to be everything for everybody. This doesn't mean that you should say no to every deal that's not in the focus, but trying to focus at least the internal efforts on the verticals that you see as most promising.
We can say that we do that with all the portfolio companies we acquire. That's the first step in the onboarding, to look into the positioning and the verticalization. Try to focus the company towards one or two verticals instead of doing it wide. So that's the important step for many of our portfolio companies. Yeah. Casper.
Yes. Let's take some questions here, but thank you very much for your presentation, Erik and Daniel. We have a few minutes left, so just to get some of the questions answered, we have here a comment/question. Here it says, when you look at the business model of software companies, you normally get a combination of high switching costs and economies of scale through R&D spend, which favors the larger companies. And then the question, when you look for new investments among the smaller companies that can potentially build scale in a niche, what do you look for? And what do you monitor on the journey to become a niche leader? So some of the parameters you're looking out for when you invest, I think it's some of it in this question.
Yeah, it's very easy as an investor to start to focus on KPIs and valuation and so on. Where we always start is on the product and focus on that one. So we try to interview a lot of experts and customers and partners on the market and see what they say about the software. And we often do a survey as well, doing an NPS survey, and see if they are happy and engaged, and if they can recommend the software to other friends and family and competitors on the market. So that's where we start. After that, we always focus on the team, because we are really depending on a great management team. So we try to find good people with great values and with a lot of drive and entrepreneur spirit, and people we can do this together with and having fun together while we're building the company together. So first with the product, second the people. That's the most important part we're looking for. And of course, we're also digging into during the due diligence process all the KPIs, efficiency in the sales, efficiency in the productivity in development, etc., etc., etc. But most important, customers and happy customers and happy employees.
Yeah, thank you. And just the last question here before the time is up. Are you also investing in listed SaaS companies? And can you see any valuation differences between private and public markets?
We actually did. So we did early days in our history. We did a minority investment in public companies. However, our model is that to be really hands-on and doing this together, and doing that in a public environment isn't the perfect match. However, we can do exits with doing IPOs. We did that with Lime, for example. So we did an exit with Lime in 2018, and really successful. So we can do exit, and then we can be a shareholder a few years afterwards, but never acquire any shares on a public company. The valuations, the second question, if we see that the valuations has been previously during the hype, during the COVID period, the valuations on the public companies were much higher. However, what we have seen now is that the stock market has decreased, and we have seen a downturn. However, now we see that during 2024, now we see that the valuations has coming up again, the public ones, and now the private and the public are pretty close to each other. So it has been a gap previously. The public companies, the valuation was higher. During the last 2 years, the private has been higher, and now we see the gap is not so big anymore.
Yeah. Great. Thank you very much for your presentation again, Erik and Daniel. It was very insightful. Looking forward to follow both your investments and reports going forward. So thank you.